smiling at Kerry there because I'm thinking it's late in the day. People have got to still hear about insurance. So that's, I pity you, but yeah, it's a bit of a struggle. So I'll try and make it as interesting as possible because I come from a different angle in that it's very much what Jonathan has gone through, thinking about the parametric approach. So I'm trying to continue that theme on by looking at a different and alternative method of risk transfer, as we call it, or insurance. Just looking at ways that might help the overall cost of insurance, and looking at potentially group buying power for farmers and how that could add value. So my session is going to touch on something called discretionary mutual funds. I don't know if you've all heard of mutuals and co-ops, I'm sure, but what I'm talking about here is insurance, mutual insurance funds. We call them discretionary mutual funds. And if you can picture, as we say there, it's an alternative risk transfer that gives group buyers, farmers, the opportunity to buy together and benefit from the group buying power. Very much how insurance started off right from the start, you know, in the 1600s, wherever that was, those coffee shops in London, a group of guys got together on the marine side of insurance and said, we've got this cargo to insure each of us. One of us won't survive, but if we all group together and pay part of it together, then if one of us goes, all won't go down, and we can contribute then to that one cargo owner that has suffered. And that's the basis of all insurance. So the thinking is to members contribute to a fund, so they partially insure and have reinsurance sitting above the fund to protect should the fund become, and I'll give an illustration in a moment, should the fund become exhausted at any time. The fund itself is there to cover day-to-day working losses, so that that's where the potential to reduce the cost, and all the insurance premiums don't all go to the insurance companies. There's some retained in the fund, but with reinsurance protection above the fund, should the fund be exhausted. So it's not insurance, it's called discretionary distribution under a company or trustee arrangement. The policy is, the equivalent of a policy is specified through a constitution or scheme rules. Reinsurance, as I mentioned, is purchased to protect the fund. Losses in excess of the fund are met by the reinsurers, and an independent trustee, a manager, I mentioned this to Ian before, that there's a trustee set up independent to control and manage the monies belonging to the members within the fund. So here's a bit of an example. It's an actual worked example that we've done with QFF, and the good thing about what we're doing now is we're working through, as part of the Future Drought Fund, and a potential prototype for a discretionary mutual fund that it'll be taken to government, and the potential of starting up something for one particular crop, which could then have application, if it gets off the ground, particularly as a pilot, to other crops throughout Australia. So if we can look at this, this is, as I say, a worked example. You can imagine a lot of farmers contribute, we call it contributions, but they're really premiums into that yellow part. So to pay for, this is just to explain to you, this was related to, for cane growers in 12 different mill areas that were exposed to cyclone in North Queensland. So those farmers, a percentage of them who wanted to join, contributed to this fund, paid in a proportion, and if they had a cyclone that exceeded a category 3 or greater, and came within 50 kilometres of their farm, they would get a payout. The payouts were in increments of $10,000. You could take out any amount, $10,000. $50,000 is what we used per payout for this particular exercise. So contributing to the fund is the cost to manage the fund and the potential payout of one cyclone hitting in 1 year in one of those locations. The good thing about it is there's good spread, as you would imagine, up the coast. So if the fund got exhausted due to a cyclone and all the amounts in the fund were paid out, then the $2 million, that arrow shows that reinsurers then take over and pay for the rest of the losses for that year up to $15 million, which was the limit that was regarded as an adequate limit for the worst possible scenario from history for the number of farmers that participated in that we were using, estimated number of participating farmers. Anything above that, if it was, extremely remotely, then they were self-insuring. But 15 million was regarded as an adequate amount. So that's the concept of the mutual. The big attraction, of course, is that whatever doesn't get used in there, if a loss doesn't happen in any 1 year, those funds that are in there belong to the members. And they can be, as you can imagine, there hasn't been a cyclone exceeding category 3 for a long time. So that fund continues to grow. Now, the challenge about this part and getting the funds for that is getting members to pay enough contribution to pay for the managing of the fund, as well as an adequate amount for payment of claims up to the total $2 million before reinsurers come in. And so that's what we talk to the government, Queensland Treasury, about capitalisation of the fund. Because let's say $1 million was all farmers based on paying a reasonable premium were prepared to pay. We needed another 1 million from somewhere to capitalise that, so that the insurers would sit over the 2 million, because that's where the best optimum value of the premium was going to be, at the 2 million, as an example in this particular case. So this still under consideration. It's been talked backwards and forwards. Love the idea, but just not quite sure. One of the challenges, of course, is we put up for sugarcane. They say, what about other industries? But we say, get it going in one particular crop type, and there's the potential that it can be used by other crops anywhere in Australia. So that's being worked on in another crop type nationally as part of the Future Drought Fund, which we're going to be reporting on by June. That's a very quick flow chart. It pictures the contributions from each of the grower farmers going into the industry discretionary mutual fund. That pays for accountants and legals, that sort of outsourced service providers. There needs to be a discretionary mutual fund manager and trustee who handles the cash, as we talked about, Andrew. There needs to be someone handling the funds. It's got to be we talked to Ian as well, it can't be us, for example. It's got to be a separate business. Reinsurance is taken out, and when a claim occurs, it's either paid out of the discretionary mutual fund up to the limit gets exhausted, then the reinsurers pay out the balance. So just a few benefits, some standout benefits. The biggest benefit is that what doesn't get used up in the fund, and there's insurers online, but insurers don't like that much because they don't get all the income, all the premium, and that's where they make their profits. Well, the profits from the fund belong to the members. The members own the fund. So any successful years where there's a surplus, then that belongs to the members for different uses, not for going to buy. We had one fund once where someone said, well, can I buy a car? I need a new ute or a piece of plant for my farm. Can I take some money out of the fund? They said, no. And the trustees control that. The fund money is for the good of all. So if it's good risk management, that bringing in new risk management netting or something, that sort of thing can be used for the good of everyone, or it can be put aside to smooth out the costs, reduce the potential reinsurance costs for future years. All that has the benefits. I think I talked about surplus is the ultimate goal, to reduce catastrophe costs. See, the ultimate aim is to get the fund continue to bigger, so the insurance that sits above it, that bright part there, is no longer 15 million, it might be 5 million, just really upper it. So you're not paying a lot for the premium where the fund itself is building up its size. Risk management, more risk management only helps the funds because it's the fund's exposure. So risk management helps the members of the fund. Improved protection, really it's not governed by the insurance company, you decide, and that's where the right sort of parametric cover is that suits members is what's taken out. They don't dictate altogether. And claim service, just as Jonathan mentioned, because what that example I just gave you is a parametric type event cover. If BOM declares that's a category 3 and above claim, then the $50,000, whatever increment you take, is paid out immediately to the farmers. So no delays, no inspection of what damage there's been, assess the delays, all that sort of thing. It's immediately dealt with. But just finally, participation, always the challenge. And really, the big thing, again, Jonathan knows, it's awareness, education, particularly with something like this, because it's different to what they're used to. And the biggest thing with any mutual or cooperative is there needs to be commitment. The people that are going to think about going into it have want to really do it. They get good management and good leadership. So we want to be part of this, and it's good for the collective participation. That's vital. So proven product, been in Australia for a long time. Local governments use it all over Australia, more than 30 years now, actually. Overseas, a very common form of insurance. In America, 5 mutual out of 14 approved. Yeah, so out of the 14 approved crop insurers, 5 are mutuals, and the good thing is they get 65% subsidised crop insurance. That makes it very appealing for them. But mutuals are a big proportion over there. In New Zealand, of course, there's the Farmers Mutual Group, which has got 65,000 members, and that's a mutual. Same concept, really large, but New Zealand's always been strong on mutuals and cooperatives. Limited take-up in Australia. CBH have got, they're basically a mutual type concept apart from their corporate insurances, but they do have a receivables wheat yield type product, which is basically that type of concept that they're using. Aussie Farmers Mutual, may have heard of, some of you might have been involved in that. I think it's still going, the old Lativo. I think that was a different sort of a concept there. Carnarvon banana industry, they set that up 20 years ago. It went well, I think it's still going. And there was Farmers Mutual listed, but it became delisted. They just didn't have that capitalisation that was vital for them to build up their program. So finally, Australia's crop insurance market is very thin, as Jonathan would agree. There's your organisation and a couple of others, and that's it. So, and it just needs more activity, more pools of farmers to participate in it to be successful. So, yeah, we believe, and that's why we've got it as part of the Future Drought Fund, looking at a prototype mutual and seeing what the appetite's going to be from government to get involved and show that it could potentially be commercially viable, because it's a fantastic way of pulling back costs, challenge the insurance industry, and widening out what is a very limited crop insurance market. Thank you, Kerry.